Hi friends, in this video we are going to discussing about mock test for chapter 4 in NISM series 7 Securities Operations and Risk Management. First question, which of the following is an example of unsystematic risk? Option A, change in interest rates by RBI. Option B, inflation rising above expectations. Option C, management failure in a company. And option D, political instability. Correct answer is option C. Unsystematic risk is a company or industry specific. Example, poor management. Systematic risks are market wide, like interest rates, inflation, or politics. Next question. Which of the following best represents systematic risk? Option A, strike in a company's factory. Option B, change in taxation policy. Option C, default by a borrower. And option D, system breakdown in a stock exchange. Correct answer is option B, change in taxation policy. Systematic risk is due to macroeconomic or policy factors affecting the whole market. Example, taxation changes. Next question. Beta of a stock measures option A, volatility of the stock compared to the overall market. Option B, profitability of a company. Option C, default profitability of a bond issuer. And option D, cash flows of the firm. Correct answer is option A, volatility of the stock compared to the overall market. Beta indicates the sensitivity of stock returns to market returns. Next question. A stock has beta is 1.3. If the market return is expected at 10%, what is the expected stock return? Option A, 10%. Option B, 11%. Option C, 13%. And option D, 15%. Correct answer is option C, 13%. Return equal to beta into market return. That is 1.3 into 10% is equal to 13%. Next question. Which of the following risks can be reduced through diversification? Option A, market risk. Option B, systematic risk. Option C, unsystematic risk. And option D, interest rate risk. Correct answer is option C, unsystematic risk. Diversification reduces company or sector specific risk, not systematic risk. Next question. Which of the following is a risk mitigation tool used by exchanges to protect against counterparty default? Option A, stop loss orders. Option B, margin requirements. Option C, dividend reinvestment. And option D, insider trading restrictions. Correct answer is option B, margin requirements. Margins act as collateral, reducing settlement risk. Next question. Value at risk measures. Option A, maximum expected loss at a given confidence level over a specific time horizon. Option B, average return of a stock over time. Option C, minimum margin required to trade. And option D, past performance of a mutual fund. Correct answer is option A, maximum expected loss at a given confidence level over a specific time horizon. Next question. A portfolio has a 1-day 95% VAR of 2 lakh. This means option A, the portfolio will never lose more than 2 lakh in a day. Option B, there is 95% profitability that the portfolio will not lose more than 2 lakh in a day. Option C, the portfolio will earn 2 lakh daily. And option D, SEBI mandates a 2 lakh margin. Correct answer is option B, there is 95% profitability that the portfolio will not lose more than 2 lakh in a day. Where at 95% means 5% chance losses may exceed 2 lakh in a day. Next question. Liquidity risk is best described as option A, risk that a counterparty defaults. Option B, risk that securities cannot be traded quickly without significant price impact. Option C, risk of wrong investment decision. And option D, risk of high inflation. Correct answer is option B, risk that securities cannot be traded quickly without significant price impact. Liquidity risk occurs when assets cannot be sold or bought easily without affecting price. Next question. Operational risk includes option A, internal frauds, option B, technology or system failure, option C, poor process controls, and option D, all of the above. Correct answer is option D, all of the above. Operational risk arises from people, process, systems, or external events. Next question. Stress testing in risk management is used to option A, estimate maximum brokerage charges, option B, evaluate impact of extreme but plausible market events, option C, predict daily trading profits, and option D, calculate interest income. Correct answer is option B, evaluate impact of extreme but plausible market events. Stress testing checks how portfolios behave in extreme adverse conditions. Next question. If margin requirement is 12% and a trader deposits 3 lakh, what is the maximum exposure allowed? Option A 20 lakh, option B 25 lakh, option C 30 lakh, and option D 36 lakh. Correct answer is option B 25 lakh. Exposure formula equal to margin divided by requirement. So margin 3 lakh divided by 12% is converted into points is 0.12, that is 25 lakh is the maximum exposure allowed. Next question. Which of the following risk management mechanisms is implemented by clearing corporations? Option A, novation of trades and settlement guarantee. Option B, publishing research reports. Option C, monitoring company management. And option D, issuing corporate bonds. Correct answer is option A. Clearing corporations become counterparty to every trade, guaranteeing settlement. Next question. Business continuity planning and disaster recovery are measures to handle which type of risk? Option A, market risk, option B, liquidity risk, option C, operational risk, and option D, systematic risk. Correct answer is option C, operational risk. Business continuity planning and disaster recovery ensures continuity of operations in case of disasters or system failures. Next question. Which of the following is an example of hedging risk? Option A, buying insurance for credit risk. Option B, shorting nifty futures to offset portfolio losses. Option C, selling illiquid stocks. And option D, taking excessive leverage. Correct answer is option B, shorting nifty futures to offset portfolio losses. Hedging uses derivatives to reduce exposure to adverse market moves. Thank you for watching my video. Please subscribe for more chapters.